Hello, and a very warm welcome to everyone joining us for today's Energy Storage News webinar, which we are delighted to bring to you with energy storage experts Clean Horizon. In today's session, we are almost literally looking over the horizon at a coming opportunity for energy storage to increase its role in Europe's clean energy transition, and in doing so, add a new dimension to the revenues that energy storage assets can earn through providing a vital service to the electricity network. We're talking about Automatic Frequency Restoration Reserve, or aFRR, which is a cross-European platform for exchanging balancing energy that will be one of the main ways that the correct operating frequency of the grid is maintained. This will be particularly important to keep the lights on across the continent as higher shares of variable renewable energy sources, like solar and wind, are introduced into the energy mix. As I mentioned earlier, it is also likely to be an important source of revenues for energy storage in Europe, which has so far lagged behind in development to other markets like the US and parts of Asia. Europe has taken some big steps forward in electrochemical energy storage for sure, but the real business activity has focused on creating significant lithium-ion battery manufacturing capacity, largely to support the switch over to electric vehicles. The European Union has committed its member states to net zero emissions by 2050, and there has been much talk of a green recovery after COVID-19. And European power markets' adoption of renewable energy currently outpaces the US and China. But according to recent analysis by Wood Mackenzie Power and Renewables, the importance of energy storage for integrating that renewable energy onto the grid has not been as readily recognized as in those other regions. Some things are changing for the better, and ultimately Clean Horizon has forecasted that Europe will deploy about 8,000 megawatt hours of energy storage by 2025, and some policy and regulatory changes are already taking place within member states, including Spain, Ireland, Portugal, and Poland, that will add some favorable conditions to the market. Now, some of the challenges highlighted by Wood Mackenzie's report include Europe's high level of merchant risk and barriers to obtaining financing, with the first tranche of frequency control services opportunities in the primary control reserve market already largely saturated, depressing the prices and revenues that storage operators can get. aFRR, which we'll be looking at today, looks like part of a new wave of merchant opportunity. Clean Horizon's CEO, Michael Salomon, has been showing clients how to monetize energy storage systems for more than 10 years. And today he'll be showing us his expert take on aFRR, what participation in it will require, and how it can help you build a business case that investors can get on board with. We're also very happy to be joined by Paola Travesso, who is a principal on the investment team at Gore Street Capital, which is a UK-based acquirer and manager of energy storage assets through its Gore Street Energy Storage Fund. Gore Street has been one of the major success stories of the energy storage industry in the past 3 or 4 years, and Paola can bring us insights from her experience on what it takes to turn merchant opportunities in energy storage into bankable revenue streams. As always with our webinars, we love to hear from and interact with you, the audience. So please put your questions for our speakers in the tab on the right-hand side of your screen, and we will do our best to answer as many of them as possible in the Q&A session later that will follow some brief presentations from our speakers, and then a quick roundtable discussion moderated by myself, Andy Colthorpe from Energy Storage News. So without further ado, over to you, Michael.
Good afternoon, good morning, everybody. Thank you, Andy, and to all the Solar Media team for having us and hosting this session with us today. And I also would like to personally thank you, of course, Paula, for joining me just after this, and also the 200 plus or 300 plus of you that are attending this webinar. And there's two options. Either you guys are all experts and you all already know what aFRR means, and you're there to perfect your knowledge, or you sort of blindly trusted either Andy, Paula, or myself into an arcane acronym to see, those people are trustworthy, maybe they have something to teach us. Anyways, thank you for being here. And so I'll just say a quick 10-second word about ourselves for those who don't know us. Again, my name is Michael Salomon. I've been running since 2009 a company called Clean Horizon. We are a one-stop shop energy storage consultant. So this means that we are consultants. We only work in energy storage. And in energy storage, we are one-stop shop. So that means we just take on any questions, whether these are market analysis questions or technical consultancy aspects. Of course, today we're going to talk a bit more about market analysis. But the reason we're confident and comfortable at analyzing markets is because we spend half of our time effectively designing and negotiating storage projects all across the world. Okay, so now that acronym, let's talk about it, and let's discuss what is the actual topic of this presentation. So I'm showing on this graph. So on this graph, everything that's not so important is in black, and what's important is in red. Okay, so what I'm showing on the top part of this graph is the frequency in any country in Europe, and as you can see, the target value is 50 hertz, and somehow something happens at a given moment. I call this an event. Which creates an imbalance between generation and consumption. In this case, there's not enough generation or too much consumption that arises, which entails a drop in the frequency. Now, as the frequency drops, as you know, the frequency should remain 50 hertz, otherwise we'll have a major disturbance in the way all of our electrical appliances are functioning. So the first thing that happens is when the frequency goes down, a first reserve, which we used to call primary reserve, which is now called frequency containment reserve, acts as a proportional controller and essentially stops the frequency in its drift. And as you can see, once the primary reserve or the FCR is activated, the frequency stops drifting, but the frequency is not going back to its target value. That's actually the role of the so-called aFRR, which stands for Automatic Frequency Restoration Reserve, and which used to be called secondary reserve. So what this reserve does is it acts as an integral controller and essentially injects a bit of energy into the grid in order to bring the frequency back to its target value of 50 hertz. So on the one hand, aFRR must have capacity on reserve. So clearly there will be, and there is, a capacity payment for this. Now, if you are a power producer or a project owner, I can see your eyes should now start sparkling, because when you hear capacity payment, you hear long-term stable revenues. You may be right, you may be wrong, but I'm very happy that you're awake. But on the other hand, it also means that energy needs to be brought to the grid. So there will also be a payment for energy, or at least some energy transactions. So aFRR, the topic of this discussion, is rightly there just after the FCR kicks in. Now, today, we place here the remuneration on FCR in various European countries for the year 2020. 2020 was a special year, as we all know, but I'm not trying to prove a business case here. I'm just trying to make a point. So the point that I'm trying to make is with the way aFRR is currently procured, which is going to change very soon, and that actually is the purpose of the discussion. But with present numbers, we already see that in the revenue line that aFRR constitutes, there is actually a lot of money to be made. The money that I'm showing here is in 1,000 euros per megawatt per year. So anybody who is involved in the audience who is involved in developing or owning storage project across Europe knows that for a 1 hour battery project, you will need, depending on various assumptions, maybe 70 or 80 or maybe 90,000 euro per megawatt per year. And here I'm showing numbers that can be half that, like in Germany and Austria, or that can be 4 times that, like in Belgium, or twice that in France. Obviously, we may not be able to provide the service with a 1 hour system, but those numbers provide a very good reason to get interested in aFRR and to see if there is an actual revenue to be grasped for present and future projects. Well, as a matter of fact, I was just trying to explain, I was just giving you an order of magnitude, telling you that if a 1 hour system was sufficient, then you probably would be facing a very lucrative market. As a matter of fact, it's not that simple. The duration that you need for your storage asset, as of today, depends on the country. It can go from 1.5 hours in Belgium all the way up to 4 hours in Germany, and even worse for countries like Spain and Switzerland. It's actually not defined yet, meaning the only way that you can participate would be through aggregation with a generation asset. And aFRR is opening up to storage in all across Europe. It started opening up in Germany in 2017, and Belgium and Spain followed suit, and France is up and coming. Now, what I'm showing here may actually be a source of concern, because this is just a summary slide. Obviously, we're just having a very short and public discussion here, but you can infer from that it looks like the rules are not stabilized yet, and they heavily depend country by country. That's, if you were thinking that, you would be right, and you would not be the only one to think that. And as a matter of fact, the ENTSO-E, which is the European Network of Transmission System Operators, has been working hard on harmonizing the rules for aFRR all across Europe through a platform that is going to come into operation a year from now, actually in July 2022. That platform is called PICASSO. There is a meaning for this acronym, but who cares? PICASSO, nobody will forget. And this platform will essentially level part of the playing field for aFRR all across Europe. And once this happens, storage for all of the countries participating in the PICASSO platform, storage will be able to participate in the local aFRR market, and there will be some common rules between all of the countries. So, you know, I've been speaking for 6 minutes, 7, I'm not really sure. I didn't use any emphatic word or curses or jokes or whatnot. Actually, what I just said now, that this platform PICASSO will open up a year and a couple of months from now to storage all across Europe, is actually vital for all of us involved in deploying storage assets in Europe. Why? Because it means a new revenue stream is going to officially be accessible and open to storage all across some countries in the continent, and I'll show exactly which countries in a few seconds. But if it's going to be operational next year, we all know that the time between the procurement, or at least the idea to start a procurement of storage, and the actual commissioning date, a commercial operation date, is actually more than 1 year. So there should actually be a sense of urgency as to deploying systems or projects that will be benefiting from this future service. Now, the way aFRR will be procured in the participating countries essentially will be through a double action. Without getting into too many details, there will be on the day ahead, at the day ahead timescale, so 1 day before the fact, each country will organize its capacity market, its payment for capacity reservation. So until at certain point, a certain time in the day, a certain time of the day before, asset owners will be able to place a bid for their capacity reservation, and depending on the country, if they are selected, this payment will be either pay as bid or pay as cleared. That's day ahead, and it will be country dependent. Now, during the delivery day, there will be another auction, which will be an auction for energy activation, either for generation or consumption, and that auction will be harmonized all across Europe, so that there will be the same price all across the participating countries, as opposed to what happened on the capacity payment, which will remain local. Now, in terms of the participating country, France and Germany will be the ones to actually start. If you paid attention to what I said, you probably are thinking that I am wrong somewhere, because I just said the platform will open in July 2022, but France and Germany will participate in Q1 2022. This is not a mistake. The way we understand it is they will be working in some kind of preliminary arrangement before the platform is open, and most of the other continental European countries are going to join between 2022 and later in 2023 or 2024 for countries in North and in the south of Europe. Okay, and so if there's many things that we don't know yet, okay, but I can tell you the things that we know, and that you should probably already start taking into account when you build your business case, and most importantly, when you size your projects. Did I mention we'll be happy to help you do that? But so the things that we know is that on aFRR, the granularity of the bids will be 15 minutes. In terms of will be 1 megawatt. In terms of the energy itself, it will be, the activation periods will be for blocks of 15 minutes, which is extremely favorable to us on storage. Meaning, even if we're asked to have 4 hours to pre-qualify, to be able to participate as a storage asset into the aFRR market, whatever happens, when we are activated upwards or downwards on energy, it will be on 15-minute periods. And by the way, within those 50 minutes, we can only be activated in full for half of that time, so 7.5 minutes. Meaning, if you have a 1 megawatt asset, you won't be able to discharge more than 1 megawatt for more than 7.5 minutes. And even better for us, up to 25 minutes before real time, we're able to modify our bid. So really, this service is going to be very, very favorable to flexible assets like storage. And so what I'm saying should be music to the ears of anybody who is willing to participate with storage into those markets. Now there are things that we still don't know. For example, and I mentioned the most important one, of course, is the minimum duration for storage to pre-qualify. It will depend country by country. Some countries may change their opinions as the date to join PICASSO gets closer, and also the kind of auction for the capacity payment is, as I mentioned earlier, is not clear and will depend on the country. For example, will it be pay as bid or pay as clear? Is not fully known at this stage. Okay, so that's that's the introduction I wanted to give to this panel. In a nutshell and as a summary, we have a new product coming up. We should all pay attention to it, because this will certainly have an impact on how we run our storage business cases, and I will be happy to take in questions later. Now, without further ado, I will let Paola take the lead and explain what she has seen in the UK and how we could perhaps use that in Europe when the market opens.
Thank you, Michael. Yeah, that was very interesting. I'm personally looking forward to see aFRR up and running and available to asset owners like ourselves. Before we go then straight into the interesting part of debating aFRR and continental Europe storage market, a quick introduction to Gore Street. First, myself, Paola Travesso. I'm a principal at the investment team, and prior to joining Gore Street, I worked in investment banking and spent the first chunk of my career doing M&A for various industries. I pass the slide. I joined Gore Street really almost since formation back in 2016, so 5 years ago. And at that time, the company was at this turning point where we identified energy storage sector as not only material for the global transition to a low carbon economy, but we also identified as a sector that had exponential growth expected in the coming years. Energy storage was an investable sector of which the landscape had really major macro pillars. Firstly, on the supply side, we saw and expect further accelerated decommissioning of power plants, of which is then being replaced by renewable generation, so intermittent sources. And secondly, on the demand side, we also see a significant change driven by a massive increase in the EV, but also a natural unpredictability of demand behavior. I think very well exemplified last year when we saw the decrease in energy consumption due to the lockdown restrictions. A bit of an odd year, but a good example. So on the back of the macro landscape, we've also concluded that energy storage assets were expected to deliver very attractive returns. And differently from the traditional renewables, returns that are naturally uncorrelated to power price movements. And why would the expected returns be so attractive then? Well, energy storage has an interesting revenue mix, a revenue profile that, although is more complex than the expected long-term PPAs we normally see in traditional renewables, it brings diversity to the investor base. We'll discuss revenue in a couple of seconds. So in 2016, 2017, we focused our intention in energy storage, and we then spent time putting together a dedicated vehicle, the very first pure play energy storage fund to invest exclusively in energy storage utility scale assets. With its IPO in 2018, Gore Street Energy Storage Fund was officially born. We also put together an investor base with cornerstones covering finance, technology, and policy. We sit on a large ecosystem of stakeholders, and we strongly believe that to be a good investor, you need to cover all those fronts. And we've built a relevant track record in this sector. We've grown our portfolio from a single 6 megawatt site in Yorkshire, in Great Britain, commissioned in 2017, to over what is now 0.5 gigawatt currently managed by the fund, of which actually 200 megawatt is really operational, up and running as we speak. So we're in a sector with high growth potential, and actually a sector that's already experienced a significant growth since we started operating in it. Selling a critical service to the grid, key to the global energy transition as an enabler to renewable growth. Attractive returns, we're able to perform and target the 10% unlevered return on a portfolio level. We created a dedicated vehicle then with a very solid investor base. And us, Gore Street, the manager, consolidated as a first mover into the energy storage sector with relevant track record and actually energy storage portfolio. And all this aligned with our ESG agenda. So no gas peak generators, nor anything that shifts from the low carbon transition motto that we so strongly follow. And focusing then on the portfolio, how did we build this over 500 megawatt that we currently manage? And what are the key differentiators of our investment strategy? Number one, really, area of focus is what we call the acquisition approach. We built a dedicated team of experts in-house, not only from the finance side, not only folks like myself, but an actual engineers team to support on deal screening and selection, construction and portfolio management. We focus on bringing economies of scale throughout our acquisitions, and we obviously became more efficient, really identifying the right projects to bring to operation. And an energy asset, in the end of the day, it's like an infrastructure investment. Construction capex will directly dictate the level of return of a given investment. So the acquisition approach is very focused on capex, focused on optimizing any spending on day one, so we can make sure to commit capital that is actually required and expected to generate return in the future. Conclusion is that our team, we spend a lot of time focusing on having competitive price building each one of those sites. And so far we've been successful. Historically, we've been acquiring sites consistently cheaper relative to other market players. And this is actually directly related to the second key differentiator here, project type. We don't take development risk, but we get involved at a very early stage. Planning permission, grid offer, and land rights has to be secured before we actually commit capital. But we work with the developers at early stages to achieve the outcome and the excellence that we expect from each one of our individual portfolio assets. Third point, and that's very key for this discussion of aFRR, is the monetization of the sites. This is obviously due to revenue, but like I said on the previous slide, energy storage sites, they're flexible and they can do different services at a given day. They can capture and stack several revenue streams throughout their life project. And Michael, you touched upon this, the stacking profile, right? But those contracts are not necessarily long-term. And as a matter of fact, a big chunk of the income of our portfolio today actually derives from merchant revenue. And we absolutely like the complexity and the revenue profile of energy storage. We believe that the monetization strategy is key to drive our target return. And we understand the nature of the business. And we spend a lot of our time actually focusing on the top line strategy. Fourth, technology. Again, it is to do with the market nature of what we expect in Europe. Our portfolio is currently 100% lithium-ion, but we are ultimately technology agnostic. We're effectively buying solutions that fulfills the market needs. In the past, we looked at different technologies such as flow machines, for instance, mostly as a response to a service duration requirement of that specific market. It was actually in Europe. So we can discuss this later when we're doing the debate, Michael. But the point is, we're focused on buying really solutions, and we're completely agnostic as for the selected technology of it. And lastly, geography. This macro landscape that I mentioned earlier is applicable to almost every single grid today. The changes on the supply and demand, they automatically brings complexity to every grid operator, not only in the UK and Ireland, where we are currently present. The energy system of OECD nations, they're all facing, a situation where intermittent generation and the unpredictable demand becomes challenging to everybody. So our mandate actually reflects this. We have today a flexibility to invest 40% of our fund in OECD nations, of which we currently have pipeline in continental Europe and in the US as well. And this is just really an illustration and a summary of the fund's history. You can see here now how we build the fund in terms of size and in terms of portfolio as well. We IPO'd this vehicle back in 2018, and we've raised at that time a modest 30 million. So a modest size fund, which it made us actually incredibly capital efficient to grow and raise accordingly. Although I do like to think that we would be capital efficient either way, but we've grown the vehicle 10x in 3 years since our last raise last month, actually, when we then made this fund now close to 300 million market cap. And we did this obviously while paying the target dividends to our investors. Aligned to the growth fund and the dividend payment schedule, we have also increased the portfolio capacity on its back, right? So you can see this in every one of the acquisitions that we've made in the past 3 years. Which then takes us to actually the portfolio, one of the largest portfolio sites available to an investor today. We built a portfolio of, like I said, 0.5 gigawatt across 15 projects, circa over 200, currently operational and performing as expected, actually better than expected, given the market dynamics of DC in the UK. I have another 119 construction, working on grid connections and gearing up to have my EPC suppliers on site. And I have another 120 currently going through application for expansion. So our grid today is located in 2 grids. You can see here Great Britain and the Irish one, and I would expect to have an additional geography on this slide pretty soon, respecting the flexibility of our mandate, like I mentioned before. And this is a well-diversified portfolio of assets in other aspects as well, beyond geography. We strategically have several revenue streams and contracts to balance our overall risk profile of the portfolio, including, very importantly, the merchant exposure. For those of you who are familiar with the GB market, and I say GB because of its one grid, grid balancing contracts are either weekly or monthly now, really. So we can assume that this is a merchant risk that we are taking with our operational portfolio there. We also have multiple suppliers and manufacturers on the technology side of things, making sure that they're all credit-worthy counterparties to stand behind the performance warranties we require. And along the way, we work with well-qualified stakeholders on the development and operational front as well. So best-in-class partners throughout the different phases of a project. And this is a portfolio with a accretive pricing point when compared to peer investors. Like I said before, one of our key differentiators is to focus on CapEx and make sure that we're optimizing investments to bring the returns that we're targeting. Full ESG, no gas peak again, or anything outside Grocery sustainable agenda. And us, the manager, actively engaged negotiating the key contracts of each one of those 15 assets, from construction period, EPCs, and so on, to the operational stage where we focus on the monetization strategy. To wrap up then, really, those are 2 of our 15 assets. The one on the left here, this is a 50 megawatt Mullavili located in Northern Ireland. It just became operational in March, and it is under a contract that we can call merchant, given its nature. And the one on the right, this is a 10 megawatt located in the UK, and also currently providing grid balancing services on a monthly basis. Andy, back at you, really, to kick off the discussion on the European market and aFRR.
Fantastic. Thank you so much, Paula. And yeah, a couple of those project pictures very familiar from our UK coverage over the last few years. And yeah, really great to get your perspective, really, and the kind of inside track from Gore Street. And as you know, Michael introduced the whole agenda really today on aFRR. We're talking about a kind of merchant revenue opportunity, and you know, as we understand, that's something that Paula, from your point of view, is something that you guys have been able to become comfortable with. So I don't know if actually maybe we'll just start with that very quickly. So the UK battery storage market kind of began with contracts being awarded for, you know, for frequency regulation services. There was the enhanced frequency response tender for 200 megawatts in 2016, which really kicked things off. But it's now moved towards more merchant models. So kind of how's the UK market become more comfortable with that idea of merchant risk for battery storage from your point of view?
I think for us, and I'll kick off and I'll let Michael jump into it, but indeed, our very first site, like I mentioned, the 6 megawatt had an EFR contract. And I like to think that UK is perhaps 2 to 3 years ahead of continental Europe. So we would see, and actually the Irish grid as well, we would see the other grids following the UK path. For us, it's to really understand the regulation and understand the rules of the game. When we put an asset in place, we understand that we will have declining revenues within the coming years. And why do I say this? We believe on this basic concept of, you know, the capex will decline, mostly driven by the battery price declining that we've seen and that we still expected. And more competition means lower price, decreasing curve for the revenue side. So when we forecast our revenue for the portfolio, we are already understanding that this will come our way, and this is how we make sense of the whole investment. So in other words, we're comfortable with the merchant risk because we understand that this is what it's needed to target the return we have. Otherwise, if you're having a long PPA in place, you wouldn't expect a double-digit return. You expect maybe 5 or 6% like you're seeing in traditional renewables. But we also have, you know, we make a conscious decision when looking at the forecast revenues and making sure that this is compatible to what we believe the market will turn, if that makes sense.
Right, yeah, of course. And yeah, I think we'll get on to the, you know, the revenues and revenue pressure later. But I guess on the one hand, you know, lower prices for energy market services, you know, ultimately that's probably a good thing for the, you know, for the bill payers really from the other side of the market, I guess. So.
And I think, Andy.
Oh, go on, sorry, yeah.
Yeah, sorry, but I think it's also about the flexibility of those systems, right? Today in the UK, if you look at it, we have multiple opportunities and we can do different things with those assets. So if we're not seeing the return, or if we're seeing different if we're seeing different returns within the different streams, we can actually play from one to the other in a given day. And you've got the grid balancing services like aFRR and dynamic containment and things like this, but you also have trading opportunities alongside those grid balancing services, right? So it's the flexibility that also gives us the comfort that the opportunity will be there and we can do different things with our portfolio.
Right, so from trading being a fairly, not guaranteed, but a really quite an easy to understand kind of platform for making revenues, to the kind of slightly more risky but ultimately higher reward kind of ancillary services markets, I guess.
Right.
Right. Okay, cool. So so Michael, back to the aFRR agenda for the day, so to speak. you know, you mentioned that it's kind of vital for storage, and you know, it's almost a slightly dramatic point in your presentation, I guess, which is, you know, really must have really caught people's attention. I think, you know, if they weren't already setting up and listening, which they should have been, obviously. But yeah, how important a revenue stream for energy storage asset operators will aFRR be in Europe, do you think? Just a quick start.
So, first of all, I will answer. Just give me 20 seconds. But the one thing I want to stress is the reason I think it's really relevant. I mean, everything that Paula explained, which on the one hand you would think, why are we mentioning this since this happens in the UK, whereas aFRR is in continental Europe? Well, as Paula really mentioned, so they are a couple of years ahead of the pack here. So that shift towards, you know, a broader stacking of revenue is exactly what we're going to face, for sure. And the emergence, the growing importance of energy trading revenues in the business cases for storage, it's what's going to happen according to our humble opinions at the Clean Horizon. We think it's what's going to happen for storage assets on the continent. So when we build a business case for storage, you know, in the first years, in the 2022, 2, 3, 4, aFRR could represent maybe as much as 70 or 80% of the revenue line of the storage project, simply because right now, you see, Paola said something, and I want to stress it again. I know you wanted to address it later, Andy, but it's a logical segue in that 80% number that I'm claiming, at least for the first years. Paola said, well, when we make our forecast, we forecast in general like a decreasing revenues, and we live with this. So two things. First of all, it's very nice that some investors are A, accepting this reality, and B, are not afraid of it, and B, and the second thing is, we believe it's structural to any market that's in which storage plays a role. I am not an economic expert, but it kind of makes sense that in general, whatever the quantity that you're storing, your business is. You live up the spread. You buy low, you sell high. Well, the more you store, the more you decrease the spread in general. Now so therefore, any market that's relying or whose price formation is heavily dependent on storage should see its spreads going down. Now, more practically, in our space, in the ancillary services world, which are very shallow markets, where the prices are formed very, very differently than on energy markets. Well, let me be more clear. In the past, before storage, the prices were formed the same way on energy market and on ancillary services markets, simply because it would be the same assets providing either the energy or the ancillary service. So if an asset selling energy was to provide service, the way they would price their ancillary service would be to price in the opportunity cost of not selling energy. Therefore, there was a very strong correlation between the two markets. That's no more the case, simply because right now, storage is just more competitive versus traditional assets at providing ancillary services such as aFRR. And they don't really have an opportunity cost at not providing it. They're going to try to provide an asset, and at some point, there will be an equilibrium price, which is the minimum price they need to make some kind of return on their investment. Hence, Paula's point, which is to say, well, CapEx is going to go down, hence prices are going to go down. That's a true statement. And any forward-looking curves that you buy on the market from very reputable companies selling price forecasts does not seem to understand this, and is hence completely false. So therefore, the price will go down, and hence my 80% is certainly going to be true in the first few years. But as storage will become more important in providing aFRR, it's very likely to push the merit order away, and hence to start decreasing the price of aFRR. And as such, most likely, the proportion of aFRR into the revenue line of energy storage projects will very likely start going down. Was it a long answer? Was a long answer. but you got it.
Right, yeah. Well, no, it's okay. I think it's probably better. A long and comprehensive answer is probably better than a short and not comprehensive answer. Certainly.
Okay.
So, I mean, that's the thing is, like, I think the point that, you know, and I think bringing it slightly back to supply and demand kind of economics, that as you did, kind of makes it, you know, even someone like me can kind of understand where you're coming from with that, I think, which is nice. So I mean, aFRR in some ways is going to possibly then kickstart the European market a little bit, kind of in the way that the EFR did in the UK, possibly. Maybe it's a little bit of a false parallel because it's a very different type of procurement opportunity. But I noted, and this is a question that a few of the audience asked as well, with the technical requirements as they are at the moment for aFRR, so it might change, I guess, by the time it's rolled out, will energy storage systems be available to participate in a range of other applications and market opportunities, and, you know, to stack revenues, and with that capacity requirement versus the energy availability?
Absolutely.
What sort of revenue, so what sort of business case can they build from that point of view?
Absolutely. The way I see it is, of course, it will depend country by country. There are still some unknowns, but so for those of you that have, so you guys mentioned EFR, so Enhanced Frequency Regulation, I think in the UK, which was actually a 4-year contract with a fixed payment by the TSO. This is not the direction in general that European TSOs are seeking. They're not, in general, for ancillary services markets and energy markets. They're trying to go the other way around, which is to have a bunch of very short duration opportunities. So the capacity reservation, unless I'm mistaken, which I could be, but should be on the order of 4 hours. Meaning the day before, you will be reserved for a 4-hour block, I don't know, tomorrow between 8 and noon, and another one between noon and 4 p.m. And so during those 4 hours, if you are selected, you may be called in for energy consumption or generation within 15-minute blocks. And you'll have up to 25, so which means that you'll place a bid for the energy for it. And for example, you can be smart about it. You can say, well, tomorrow I'm kind of afraid that I may run out of juice in my battery. So here's what I'm going to do. I'm going to bid a reservation between 8 and noon and between noon and 4 p.m. But I'm going to put a price that's so high that I'm never going to be called. And if I am called, it's fine. I'll be able to discharge this battery. And with the money I'm making here, I'm willing to take the penalty for not being present later in the evening on another service on which I'm willing to buy, on which I'm willing to participate. So you could say, again, I'm making this up, I don't know the exact rules, but you could place an advantageous bid on reservation, on capacity reservation, which will be remunerated, and you could also place an energy bid between each quarter hour between 8 and noon at 10,000 euro per megawatt hour, in which case you won't be called, and if you're called, it's jackpot anyway, so it's kind of a win-win situation. So those kind of arbitrage, those kind of sophisticated trades will be made possible, and as you see, I'm talking about very short duration, 4 hours, 50 minutes, so while you're not reserved to provide said services, then you're free to do FCR or any other arbitrage on the balancing or energy markets in the future. So in the future, in the very near future, the way an energy storage project valuation will look like, it will be FCR, aFRR, it will be trading between the balancing and the balancing market and the various intraday and day ahead market. Here's 5 opportunities. And there will probably be also, like in other regions, like in the UK, a capacity mechanism, not to be confused with the capacity reservation of aFRR that I mentioned. The capacity mechanism is actually a long-term payment, either annual or multi-annual. It's a small fee that you get for being available. So in most countries, you'll be able to participate simultaneously in 5 or 6 revenue stacking opportunities, to which you could also see some other add-ons, such as local flexibility mechanisms, like you have in the UK, which, as Paula rightfully said, are ahead of the curve as far as we're concerned. Meaning, if your project is located on a location where there may be some voltage issues or some congestion issues, you may be remunerated from being able to withdraw or inject energy at a given point during the year or during the month. So 5, 6, 7 opportunities will be the daily life every day of storage assets in Europe.
And Michael, I think you're absolutely right. For investors like ourselves, for asset owners like ourselves, we need to have visibility on options, really. So, you know, similar to the UK, where under grid balancing you've got DCs and FFRs, you're talking about having, you know, FCR, what used to be the primary reserve in Europe. You know, on the secondary, where depending on obviously what's going to be the required duration per country and things like this, you would also have the battery sites being available to provide those services. And hopefully the capacity market mechanism will actually have derating factors that goes in favor with the regulation of battery duration within the aFRR, right? So for us, and lastly, trading, which I think in Europe it's slightly more granular and extremely interconnected, so potentially less volatile opportunities like we see in GB and Ireland, but still also perhaps a sort of third bucket there for us to be able to tackle. But I think most importantly, what we need to see as an investor that is day one, that project has to be investable in essence, right? So one, we have to have clarity of the rules, so we understand how is it that exactly how we're capturing a specific revenue, and how can I reflect that on my EPC, really on my system, and how can I minimize the cost to make sure I'm capturing the max revenue on day one and having a payback period that's potentially sort of as low as I can, really, and still, like I said, underwriting returns with a forecast curve that we expect to decline, really, within the coming year. So a very long answer to say, we do believe farther revenue opportunities will come our way in Europe, because it has happened in the UK. But normally when we looked at entering a given geography, a new geography, and we've done that 2 years ago when we went to Ireland, we need to see and we need to underwrite the 10% with the revenues that are available today. And that's why we believe aFRR might be an opportunity that will allow us to enter Europe, because it comes as a complement to FCR, right, to the primary reserve. And now sort of enabling batteries to play within the field as well, hopefully.
Great.
Excellent.
Welcome.
I mean, you very much answered the next question I was going to ask, actually, Paolo, which was that, you know, basically the UK, and maybe you have covered all this, but, you know, UK battery storage has been able to successfully stack multiple revenue stream generating applications, but I mean, it hasn't always been smooth sailing. Like, I think the first derating factors in the capacity market, as it was reconfigured, you know, kind of kept a lot of people out due to kind of duration requirements and things like that. But I mean, what more do you kind of, from Gore Street's perspective or from your rivals' perspectives as well, you know, investors, do they need to see really in terms of that European sort of certainty, I guess?
You know, Andy, when I was telling about this other technology that we looked, this other project that actually had the flow machines, the vanadium batteries in the past, and it was actually a project in Germany. And at that time, it was also a project that was sort of targeting the secondary reserve, which is now aFRR, right? And for us, what made it very challenging to actually officially enter the European market was the change of rules. At that time, that was back in 2019, the way the merit order will be looked at, the net capacity and activation prices, how you would sort of secure those, it kept changing all the time. Within the period of, I think, 10 months that we were involved in that project, we've seen 2 significant changes that really shaped completely different the way we would capture revenue from an asset owner perspective. Those are the things that makes it very challenging, you know, from an investor's perspective. We need to have visibility on the rules of the game. And interestingly, if we look at the GB, when we spend a lot of time actually trying to what I call future-proof our assets. And what does that mean? I want to make sure that on day one, I'm letting my assets be as flexible as possible. And I go from, you know, very technical concept of a rump rate restriction. I want my sites to be able to, you know, respond as fast as possible, even if that response is today sort of higher or, you know, faster than what I'm actually being asked for today, because I want to be prepared for the new future, you know, the new revenue streams that might come our way. And in Europe is the same. We would do it's a very similar approach, because like I said, the sort of the market background is very similar, but we would work to have a site that has minimum capex on day one and it's future-proof for what is going to come our way. But we also want to make sure that today what's available to us is clear, the concept is clear, the concept is there, and I can make sense of the underwriting return.
Right, okay. So, and I mean, it's quite interesting what something you were saying about I mean, for example, the flow batteries that you're looking at, you know, there's a lot of, as a journalist writing about energy storage news, I feel like there's almost more kind of pressure to write about flow batteries from people that tell me to write about flow batteries than there are actual projects happening. But what you're saying is it's not so much the technology risk or a lack of bankability in the technology, but it's just not clear yet whether you really need that to answer the business cases that are open at the moment, I guess. Is that kind of right, or have I?
That was actually back in 2019, so I wouldn't say it's something completely at the moment, but it was the flow machines. They have higher capex, really. They're longer duration. They have a more resilient degradation profile. But for how the market was actually awarding the participants, which is now we see in terms of faster response and things like this, you wouldn't really need a faster duration, but just to pre-qualify. So it's almost like we had to commit a very big capex, a very large capex on day one, but we were not seeing the return in the coming years. And because of the changes of regulations at all times, we were not comfortable with how that revenue profile will look in the short term. So that was the problem back then. And indeed, I think for the grids that we are located, we also see the market actually awarding different things than the very long duration. And that's why we hope and we expect that the continental Europe follows and goes for something like an hour or 2 hour duration requirement, other than the 4 hour. If you know the 4 hour is just a pre-qualification matter, but you're not really getting paid for all that duration, like Michael mentioned.
Right, okay. And Michael, so I mean, we've had a couple of questions from the audience on this as well, but
I'm trying to answer the questions, but they come too fast.
I can see you're quite keen to get to the audience questions as well. But, so the duration requirements for aFRR, could you maybe just talk us through how you sort of see those kind of working out at the moment? What sort of duration of battery storage is kind of needed to capitalize on the aFRR opportunity? And, you know, will that impact on the ability to get project finance? And also why so much difference between the different countries on that? Not just the duration, but you know, the windows that you're talking about.
I don't think I'll be able to give a satisfying answer, so I will do my best. But the way I would say it is generically for FCR, the requirements were more or less almost the same country to country, because essentially we're trying to solve an issue only on capacity. There was no energy involvement, so I would say we're really trying to solve a global problem. I understand that with aFRR we're also trying to resolve the frequency, but since energy needs to be injected, then it's going to be up to each TSO, up to its jurisdiction to decide. I would say exactly how they want to rely. What kind of rules in terms of, especially in terms of duration, they want to impose on their assets, because they may have different understanding or different interpretation of what is acceptable in terms of being there to provide for the grid, for how long it should be providing for the grid. So and one example for that is each country. We mentioned capacity mechanisms where generation assets are being paid an annual payment just to be in the market. And storage is eligible to capacity mechanisms in all countries, but with different what's called derating factor. So if you have, say, a 1 hour battery in the UK, I believe you only get 10% of the money compared to a normal generator, meaning they're thinking that, well, 1 hour is just not enough to solve our local problems. But in France, you would get almost 100% of the payment, because they're saying we really never have longer duration problems. So you see the duration is kind of intrinsic to both the local status of the grid and the local, I would say, appreciation of risk by each TSO. So that duration is probably going to remain something different country by country. And so to the question, for example, if the minimum duration is 2 hours in country X, is it better to just have 2 hours of battery, or maybe 3 or 4, depending on the other revenue streams? So to your question, what's the, what would be the ideal duration for storage in Europe looking forward? My answer is, first, buy a study from Clean Horizon. We'll do this something dedicated for you. Oops, that was advertising. The number two, I really, I really don't know, because again, it will depend on the other revenues that you will get in country X, and those revenues will be a function of the status of the country. So, for example, take a friend that has a lot of old nuclear. Is a very different situation, for example, from Belgium, even though they're neighbors, that has some even older nuclear, but not enough, and has an inherent lack of flexibility, which also will be a very different scenario from Germany, for example, which will rely maybe more heavily on wind or whatnot. So very, very difficult to give a generic statement and say, oh yeah, 2-hour assets will be sufficient, goodbye.
Right, okay. And while we're looking at, sorry, I'm just thinking that we should really get onto some more of the audience questions. It's pretty much straight away, but
it's impossible. There's too many.
One question that that someone in the audience asked, and I think that also I was quite curious about, was the timing of the introduction of aFRR in all the different European countries. So obviously, you said that France and Germany are going to be among the first. Is there going to be an advantage to being first mover into that from the TSO point of view?
Yes, I'd like to comment on that. From the TSO point of view, that I don't know, but from the project owner point of view, bouncing back on what Paula said, I'm really glad that we're participating together in this webinar, because you have a very good example of an open-minded investor, but can I comment, Paula? There's a limit to the open-mindedness, right? And the limit was clearly stated. And she said, look, of course, I'm willing to take any risk, blah, 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 but at some point I need to know what I'm getting into. And if the rules are not stable, I'm not that crazy, I'm not going to go. I want to wait for the rules to be finalized, and then I'll go. So, fine, logical, acceptable, and there's no choice. That's how some of the most forward-thinking money is thinking. So if you're not thinking like this, you may have a problem. But on the other hand, from what I mentioned earlier, the more storage participates in the market, the more prices go down. So there may be another vision of the risk, maybe taken on the owner's own equity, maybe to say, well, I'm going to develop a project, 4 hours, 3 hours, 2 hours, whatever. Yes, I know the rules are not fixed yet, but I don't care. Because for the first few years, I will be the first and only storage to participate in country X, and I'll get all the juicy money. And yes, later, when the rules are more clear, people will flock and bring the market prices down, and then I'll be just one like the other. So there is, in general, always a first mover advantage for an asset owner to be among the first to participate in an ancillary service market, because as I explained earlier, those markets tend to be shallow, and the price on said markets are brought down by storage. But by doing this, you're taking extra risk, which some investors may not be ready to follow, and for a good reason, because there is a regulatory risk. So it depends, how do you balance those two as an owner, as an investor? Maybe you want to comment on this, Paula?
Yeah, no, and I think you make a great point, because actually, if you look at Great Britain, we took advantage of being first movers, right? We took advantage because we secured, let's say, the EFR contract that was only 200 megawatt back in the day. So we had that in portfolio. And we were also one of the first ones to actually provide dynamic containment, which are now at their cap price. And we obviously expect those prices to decline as we see more competition entering those services. So I firmly believe that, your statement is correct. Once you're a first mover, you take advantage of higher prices that will will suffer the pressure of competition. But what we have a problem with that is that ultimately, when we talk about the grid balancing and the ancillary services, it has to be a regulated market. And I don't know if it's because we've seen the changes in Germany back in 2019, and that changed it drastically the way we would get paid. We commit a very large CapEx amount on day one. And once you commit that CapEx, you know, you're expecting the payback period in a certain number of years. If your market shifts completely, you're already committed, right? So 80 or 90% of your IRR is completely dependent on CapEx of day one. So let's say if I enter a market like Germany that today requires 4-hour duration only for pre-qualification, not for awarding me or paying me anything, you know, different for that duration specifically, I am committing a CapEx that obviously is not apples to apples. It won't be 4x, but let's say it's something like that, then I won't actually be awarded for it. So that is why we need the visibility to make sure we have a tailor-made solution and an optimized CapEx that I can then underwrite my 10% return. Otherwise, you know, what we saw back in 2019, we had a hard time actually getting to the 10% return that we you know, required to tackle the sort of merchant risk that we see on energy storage throughout the different markets.
Right. Okay. So question here from audience member Alan van Balagoyen. I hope I got your name right there, Alan. Alan's asking if the business case in aFRR looks similar if the batteries are standalone assets compared to combined with thermal assets. I think there was another question asking about hybrid kind of co-location with solar or wind. Is that something you've got a view on?
So myself, is it for me?
Yeah, I guess so. Okay. Yeah, the aFRR guy. Yeah.
Sure. Okay. So in general, not really. The short answer is when you co-locate, you're maxing out the loading of the point of connection. You're maximizing the usage of your access to the grid. For example, you have PV in the day, wind in the evening, and storage in between. So your connection to the grid will be used as much as possible, physically possible. But by doing so, obviously, you're depriving the storage of some of its flexibility. For example, PV plus storage. Well, at noon, the PV will probably be using the connection, so it won't be available to the storage. And I'm saying, in general, it's not a very good idea because you're using most the asset, which is the point of connection, which is not the most expensive, right? So in order to use it most, you're depriving the most expensive asset, the storage, of its full access to the grid and hence to, you know, the God-given money that comes from the markets. So in general, in Europe, those things are not usually a very good idea, but there may be exceptions, and those exceptions will be when for some reason the connection to the grid is very expensive because you need to dig 50 kilometers of underground copper cable to access it or whatnot, but that's not the generality. In other jurisdictions, in some parts of the US, in Israel maybe, it's different because there it's the grid connection that's for various reasons very, very expensive. And then in those countries you won't hybridize, but it's not really the case in Europe.
Right, okay. Paolo, from Gore Street's point of view, like I really know you guys as, you know, doing front of the meter standalone battery storage in the UK, and you know, very happy to see that under your ESG thesis, you definitely wouldn't co-locate with gas generation. But I mean, for example, Spain is seeing, you know, a real boom in solar projects going online. They've got a really high target for energy storage over the next 10 years. Is that, I mean, I guess maybe you'll be more focused on more immediate kind of opportunities at the moment, but is something like that with co-located batteries with solar and then potentially playing into some of these ancillary services markets something that you see as viable?
We haven't looked at Spain specifically, but we have looked in GB and we've looked some things in France as well, and we haven't really made sense of it. Actually, the co-locations that we've got in GB, which we call it behind the meters, really, it was just a way to optimize grid connection costs. But essentially, we are providing, like Michael said, really, we are providing grid balancing services directly to the grid. And in terms of monetization strategy, we don't find it more attractive to have a co-location as of today. Obviously, things can change. In the UK, there were a couple of revenue streams that could come from a co-location, like the triads, which is basically a big shifting, shifting supply and demand when our partner needs it, but it's not something relevant on the overall revenue scheme of things. No.
Right. Okay. Well, we'll wait and see how that one pans out. So, got a question here from audience member David Pedraza. He says that apart from the capacity markets, it seems that almost all the potential revenue stacks in Europe are kind of pure merchant. David asks, how do you think lenders will see these revenues? And are there any project finance possibilities with this business model? Michael, do you want to maybe start off with that one?
It's a very good question. It's true, it's merchant-based. So there's an exception to it. The capacity, you're right, actually, no, you just said it. No, this question is really well asked. The capacity mechanisms provide a little bit of revenue guarantee. But of course not enough for full financing of the assets. So what we have seen in some examples, we have seen cases with project finance, so with the debt lenders kicking in, but they kicked in the examples that I have in mind, I believe not higher than 50% of the total cost of the total, the gearing ratio was 50%, and there are also other strategies where some players would own the assets for 3 years, maybe alongside private investment funds or equity, and then would try to go to the market after 3 years when those assets have been so-called de-risked, when they have a bit of history of revenues to share with potential acquirers and lenders. But maybe Paola, you want to comment on that? How you guys did in the UK? Yeah.
Happy to jump into that because, interestingly, when we started looking in the GB market back in 2017, debt was actually as expensive, probably like equity cost. Really, it would make no sense for us to try to leverage any one of the projects or at a fund level. But then we've seen that the more energy storage market consolidated, the banks actually understood, the commercial banks started understanding the business model. And we started seeing some of those banks actually lending to fully merchant risks sites. We've seen, I can mention one because it was with us and this is public information, but we've now secured with a lend facility, a debt facility with Santander, really, and this is 15%, up to 15% of our fund. That's our current mandate, and they got comfortable around the merchant risk. And again, I think it goes back to those sites being flexible, being able to provide different revenue streams, and actually this being, the revenue being a critical service that we provide to the grid, something that we don't expect to go away anytime soon. And I would assume that banks are the same. So I think revenue stacking, flexible sites, plus market dynamics really plays a role with now the merchant banks understanding the market dynamic and actually the projects being bankable, and we are able to leverage fund level and project level.
Right. Okay. So I mean, it's a process of kind of getting, once the bankability of the technology becomes better understood, the revenue streams become better understood, and it kind of all falls into place. But there's a question here that I seem to have lost the actual question, the person's name. But they were asking on the potential for competition for other types of assets to provide aFRR. So the questioner was asking if, for example, existing pumped hydro might be a good option for performing the aFRR services. How do you sort of see that? Is there a competitive threat from other resources?
No, absolutely. There is. The aFRR market is not open for storage. It's open to storage, and the logic in general It comes from the European Commission. There's one directive whose name I forgot, but essentially the idea is to open competition to every energy market, to as many assets as possible. We're all getting excited because the way the rules were written, they were written mostly for generators and to some degree for demand response assets, and they were unfavorable to storage for many reasons. But those rules are changing, and they're not pushing other assets away. They're just opening to another kind of asset, which is storage. But so there will be competition. There will be competition there's many things that can happen. For example, I can give you just one example. the way, for example, aFRR is provided today in France. The way this is provided today in France, it's not a market. It will be a market when we join PICASSO next year. Today, it's an obligation on each generating company to provide aFRR pro rata as a proportion to the amount of energy it produces every week or every day, I kind of forgot. Then, so that the nuclear power plants in France have some kind of embedded controller that generates secondary reserves, so aFRR, sort of automatically. When the market opens up, will the nuclear plant operators change, I guess, the way their assets are controlled, or won't they? Will the market signal be sufficient for them, a sufficient incentive for them to sort of revamp a little bit the way their plants are produced? And what kind of impact will this have on the aFRR price in France, actually, and then in all of Europe, at least for the energy components? It is a bit difficult to predict, to be very clear. So on aFRR, for sure, as the market opens and as a price signal starts spreading through, market participants, they will adapt their procedures, whatever that word means, in order to be more competitive. And so this is, again, one of the reasons I'm saying with something that's a bit risky, to say let's start, if we have storage ready day one to participate, that asset should be making money before the rest of the sector realizes that there's actually money to be made and then adapts their procedure. So procedure being could either mean investing in more storage assets, or could mean the example that I just mentioned with the nuclear, which is some kind of revamp of their controllers.
Right. Okay. So I think we're kind of running out of time now, pretty much, and we've gone a little bit over our allotted hour. So great value for money for this free webinar for everyone watching, I guess. If we could maybe just do 2 more quick audience questions, if that's all right with you guys.
Sure. And I also want to say, if people have more questions, they're okay to send it to me. The last question is a complete suck up. He's a guy who works for me, and he just says, "Thanks for the interesting content." Naeem, this is a shame.
Nice of him. That's nice of him to say so. Yeah, I mean, I should mention as well that the presentations from today, as well as the full recording, will be available on demand on the Energy Storage News website. The slides will be sent to everyone who's registered. I believe, actually, Michael, you might get an opportunity to reply to the questions, via email at a later date as well. So great. We'll just make 2 more, hopefully not colleagues of yours, happy with answering their questions now. So Pierluigi Visconti asks that, he says that aFRR is procured at country level to maintain the real-time power balance at the borders. I'm not sure about that, but why is a European platform needed? Why have a European platform to manage it? Why not just keep it within sort of each country's TSO, and why sort of unite them all together in Project PICASSO?
I have no clue. I don't know.
Fair answer. Okay.
The Pierluigi is smart, so he'll figure it out.
We'll wait and see on that one. Okay. And yeah, okay. So last one, I guess, and it'd be nice to get both of your views on this, really, and you can wrap up with any closing remarks you might have. So Robert Prate asks what your expectations are with regards to future aFRR prices. And I guess, it's in common with what we were saying before, kind of, I guess, as the market, has more providers in it and becomes more efficient, I'm guessing prices will go down, but I'm just a journalist. I'm not here to answer the questions. How do you guys view that? And, how does that sort of fit in? So firstly, Michael, what's your view on that over the next few years?
Price will go down. I agree with you, Andy.
Okay.
There's no other choice. Like I said, I think they should go down up to a point where there's nothing that's bringing them down together, that's bringing them down further. I'm sorry, whatever that thing is. But yeah, for sure, storage again has no. I'm going to repeat the thing that I said, but it has no opportunity cost at delivering aFRR, so they will try to beat as low as they can. Period.
Sure.
I think, Andy, from, we've been sort of talking to a couple of developers that has some projects in Europe, and when we always discuss what do you believe is going to be the mix between FCR and aFRR and things like this, and obviously pricing is potentially the most important component. And I think this one is a wait and see how it starts, but absolutely, like Michael said, we believe those will be declining prices, which then sort of corroborates, that first movers will have an advantage. And also, it's the expectation that you will have more new entrants as the whole European market evolves, and you've seen sort of positive prices for available services, FCR and aFRR as well. So other than, like what Michael said, declining prices, I don't think we can sort of read the future too much as of now.
Okie dokie. And as we've seen, forecasting is a dangerous game, really, isn't it, for industry watchers, certainly. Okay, well, I just want to say one last time, thank you so much to everyone for joining us, sticking around for what's been a fascinating discussion. I really look forward to hearing more and writing more about what happens in the European market, and what that means for the future of the energy transition, really, I guess, which is what brings us all here in the first place. So I just want to say thank you very much to Paola Travesso from Gore Street Capital for taking part. And thank you very much to you, Michael Salomon from Clean Horizon, and of course to everyone in the audience.
Thank you, and thanks for your attention. Bye-bye.
Thanks, everyone. Bye.